trend. I believe gold is just at the beginning. It's, a lot of people see this as potentially the end. It's obviously not the very beginning. We've seen some of that move, but there's a lot of other assets that need to catch up to the metal, of which we historically tend to lag a little bit before we see the bigger moves. And so I'm extremely excited about some confirmation of the thesis, but personally, I think there's a lot more to go. Today, the government debt in the U.S. is backed by about less than 2% of gold reserves. Okay, this is valuing gold at today's prices, not the ridiculous, $40 an ounce that we hear from the Treasury, from the Treasury secretaries. So what I think it's likely to happen if you just revalue at more appropriate levels, let's say 10, 15%, which we saw back in the 70s, you get a gold price somewhere close to $20,000 an ounce or so.
Gold has surged over 20% this year and has doubled in price since 2021. The rally gained momentum after Russia's 2022 invasion of Ukraine, which led to Western sanctions and the freezing of Moscow's dollar and euro reserves. In response, central banks globally began aggressively buying gold, fearing similar asset seizures in the future. Soaring inflation, ballooning budget deficits, and renewed political uncertainty fueled demand. The election of Donald Trump and his subsequent trade war and criticism of Fed Chair Jerome Powell added to the pressure on U.S. assets, reinforcing gold's appeal as a haven. With U.S. federal debt now at $35 and $36 trillion, Tavi Costa argues that gold is still deeply undervalued. He suggests that if gold were revalued to back just 10 to 15% of U.S. debt, levels seen during the 1970s, it would imply prices between $15,000 and $20,000 per ounce. Wall Street is taking notice. Goldman Sachs recently raised its gold target to $3,700 per ounce, citing rising policy uncertainty and signs of a slowing economy. UBS and Bank of America have also issued $3,500 targets, which are projected to be further upside from current levels. A Bank of America survey found that 58% of global fund managers consider gold the safest asset during a trade war. Costa emphasizes that gold miners thrive in this environment, with high margins above production costs. He calls it a golden age for the industry, making now a potentially exceptional time to own both the metal and mining stocks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
I think the problem with price targets is usually that as you see things moving in your direction, the price target could change. And so that's the biggest concern is how the whole factors you're using to come up with that price may change over time. I will explain one example of that. For instance, a lot of people use monetary base to try to price gold. What if monetary base, in 5 years it starts to contract for whatever reason? I'm not saying it will, but then it changes the completely of your the picture of your target price as well. And I don't think it's very reflective of the gold price just because it's a small number of what the dollars available out there. I try to use M2 money supply, but money supply, which is a broader way of looking at the amount of money available in the system, also does not reflect very well. We're about $20+ trillion in the U.S., of which it's not really reflective of all the dollars that are floating around. And then I use the government debt. Government debt is a really outstanding way of maybe looking at this, because that's, that really is majority of the dollars out there. So you've got about, just to make it math simple, about 35 trillion, more like 36, but $35 trillion. And then you look at, all right, well, $35 trillion, we revalue gold at its price today, how much gold officially the U.S. government has. We may say that the government, securities are backed by military and other things, but ultimately is really backed by gold. And people will learn that lesson on this as well. I mean, a lot of people are changing their tune, saying, no, it's about military. It's really about the gold. I mean, ultimately, whoever got more gold their currency will be valued, better, accordingly. And so I thought that was the best way to look at. And, back in the 40s, running, as we were getting into the Second World War, what we saw was that we were about 40% of the government debt was actually backed by gold. Well, that's remarkable. And then, as we saw money supply and debt creation in order to enter the war, that ratio declined, to, 20% or so, or 30%. And we enter a downward trend of that. In other words, government debt has been rising at the same time as the reserves actually were sold before the break of the gold standard and after the World War II. And since then, we've seen gold, reserves being basically static, at least as far as we know in the U.S. And so how do you value gold? Well, today, the government debt in the U.S. is backed by about less than 2% of gold reserves. Okay. This is valuing gold at today's prices, not the ridiculous, $40 an ounce that we hear, from the Treasury, from the Treasury secretaries. So what I think it's likely to happen if you just revalue at more appropriate levels, let's say 10, 15%, which we saw back in the 70s, you get a gold price somewhere closer to $20,000 an ounce or so. If you get it closer to the 40%, which is a very extreme number, you get it close to 50,000. So things are fluid, of course, but that gives you a sense that, this metal is really cheap at $3,000, $3,500 an ounce. I mean, of course, things move too fast in a quick direction. We can see a correction here and there, but that gives you sort of that, light at the end of the tunnel of where we could get. And who knows if 10, 15 years from now, we're going to see debt at 36 trillion. We could see a 40, of which would increase my price target. So that part is fluid, both sides. And so yeah, that's a good question. I think it's central banks being forced into acquiring the metal, in a situation of where, clearly there's deglobalization trends that are forcing folks to buy a neutral asset. I think that's probably the most important one. I think it's the knowledge that secondly, I would say the knowledge that we have so much of a debt imbalance that the only way out is inflating ourselves out of this. And also the fact that we may see, potentially, an inflation problem, entering an inflationary decade that is also accompanied by suppressed interest rates, either through manipulative policies, that are forcing interest rates lower, or not. And my view on this is that's the supercharged environment you get into for hard assets when you create that, scenario. And thirdly, which has maybe less to do with other things, you can point to a lot of things. I mean, the fact that gold has been, under allocated as a capital for, in terms of portfolio construction, 60-40 portfolios, all these things. And certainly that has to be one part of it. The capital flows, that have completely ignored the metal as a defensive asset. And now people are being forced into learning a history lesson about the credibility and the importance of owning gold in your portfolio. And I think we're still in the beginning of that. I know a lot of people are saying, well, we've had too big of a move. I wouldn't be touching gold right now. And I don't think that's a very strong, thesis at all. I think that's, applying technical analysis into what we're seeing, which is, in my view, a real monetary realignment, using Scott Bessent's, term before even being appointed as the Treasury Secretary. I think that's really what we're, facing right now. And so I think owning gold is absolutely critical in this environment. And so I highly, I would speak very highly of the metal just because, but more importantly, if you think about it, with gold prices where they are, it's hard to ignore the fact that you also have companies that produce the metal, and they're not seeing their costs rise anywhere close to gold prices.
As global economic uncertainty rises, nations with substantial gold reserves are increasingly viewed as more financially resilient and better equipped to hedge against currency risk. The United States leads the world with 8,133.5 metric tons of gold, valued at over $628 billion, making up nearly 79% of its total reserves. Despite abandoning the gold standard in 1971, gold still underpins U.S. economic credibility globally. Germany holds the second largest reserves, while Russia and China have been aggressively expanding theirs to reduce reliance on the US dollar and assert economic sovereignty. However, as Tavi Costa points out, while central banks globally now hold gold at 60-year highs, the US sits at a 90-year low in terms of gold reserves relative to historical levels. They better get moving, Costa warns, emphasizing that the global gold accumulation trend is accelerating, with or without US participation. Now, let's redirect our attention to a video.
The great rotation is the idea of how we may see, you can call a rebalancing rotation, use any name you want, but it really comes from the fact that we've seen financial assets become extremely overvalued. And you can kind of dive into that. The beginning of all this was looking at equity markets in the US relative to commodities, relative to hard assets. And clearly we're seeing one of the most undervalued periods for hard assets relative to financial assets probably in history. When you dive into the financial assets problem and you want to understand where that's coming from, yes, there's some broad issues as well, but it really is specifically coming from the US. It is specifically coming from technology here in the US as well, or there in the US. And so I think that this is quite normal. We see leadership take place in some parts of history, and then that changes. And I think what people are missing is that, these types of outperformance from one sector, they don't last forever. Those things change over time. And, taking a step back and thinking, okay, maybe it's too much hubris to think about what causes the rotation. In macro, from my understanding, humble understanding of how things work is, certainly all these things, they don't happen abruptly. You can kind of see these things from signals coming. It's almost like the gold market. You think about how miners have been lagging. Gold started to move. It's like the least risky way of investing in hard assets. When you think about it, it's probably gold. It's got less volatility. It's got a lot of liquidity. It's a huge market. So that's where people went for it. And then as they feel comfortable and make money on that idea, and that's when you start seeing this capital movement into the seniors, and then finally into the other parts. And I think we're in the process of seeing this great rotation already happening. I mean, we're seeing mega cap companies starting to struggle. We're seeing other sectors of the economy starting to do better. People questioning earnings and other things that are supposedly supposed to grow forever, but we all know that there's an end to those fundamentals improvements. And so we're kind of in the middle of in some parts of the rotation are happening much quicker than others. But if you think about it, there are other parts of it, like the dollar. The dollar is highly linked to gold in terms of when you have a gold secular bull market, the dollar tends to also peak. And you have this sort of long-term downward trend of the dollar versus other fiat currencies. Nothing to do with gold, but all to do with the fact that people are starting to sell their US-based assets, buying international assets, and also buying other things that are supposedly not connected to any sovereignty, so hard assets. And so I think all these things are unfolding currently. And, and not to mention what we're seeing in terms of deglobalization, of which countries are going above and beyond to secure their boards and also make sure that they have all the necessities of metals and commodities. And, there's a reason why you're seeing Chinese copper imports surge and all sorts of things. Everyone is looking inwards and trying to protect themselves. And so, this is not new in history. And, what I try to do is just learn from the past and see what applies. Of course, things are different, but a lot of things are going to be very similar as well. It wouldn't shock me at all if it's the Treasury in the US that is buying gold recently and driving the metal price higher. The main reason for that is because if you look at what the measurements that they can do without using the Federal Reserve in order to manipulate interest rates lower and using the Treasury buyback system, what they need is cash in the TGA account. The TGA account is just a Treasury cash balance. And in order to improve that cash balance, what you need to do is to have more collateral. And so gold prices are still valued at ridiculous low level, historically speaking. And so if you revalue gold, let's say in a few months, the change that it does is that it increases the collateral value, increases the value of your cash available to do things. And so, of course, the government's thinking about that as a potential change in things. And it wouldn't shock me at all if we see a revaluation of gold later. And in order to do that, they also probably want gold prices to be much higher in order to allow them to have even more capital to be deployed in other things. And so what I find it fascinating, and it's not against the crypto space, but it really is amazing to me that people have such a high conviction on crypto and all that. And when they hear that the Treasury is likely to be building a position in Bitcoin and other things, look, from my understanding, if a large party is really interested in buying something, they don't announce it to the whole world. They buy it and they announce it. And so the fact that we have not announced to the world that we're doing something on gold is extremely bullish. Leave it alone. Let them do their thing. They know the value. I mean, Scott Basson's, biggest position in his hedge fund was what? And the same goes for Donald Trump. He knows the value of gold. Everything that he builds has got gold everywhere. I mean, and so I do think, and he tweeted recently, he who's got gold, has the upper hand on negotiations, something along those lines. I'm paraphrasing what he said necessarily, but, he's right. And so, I do think that, this accumulation of gold from central banks is the U.S. is going to likely to be part of this as well. It has to become part of it. It has opted out of this accumulation of the metal recently, but international central banks are at a 60-year highs in gold reserves today, and the U.S. is at a 90-year low. So they better get cranking here.
Gold has surged over 20% this year and doubled since 2021, driven by inflation, geopolitical tensions, and central banks rushing to secure reserves amid de-dollarization. Major banks have raised price targets above $3,500 as financial assets face pressure and capital shifts into hard assets. With global gold demand hitting record highs and speculation that the U.S. Treasury may be quietly accumulating gold, the metal is increasingly seen as a key strategic asset in a rapidly changing economic landscape. Are we witnessing the beginning of a significant rotation from financial assets to hard assets? Can gold realistically reach $15,000 or even $20,000 per ounce in the coming years? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed.